Airlines are some of the most recognizable companies in the world. Their logos are painted on massive aircraft visible from the ground. Their brands are plastered across airports, billboards, and advertisements. Their planes move millions of people across the globe every single day. And yet, despite all that scale, all that visibility, all that apparent power and reach, airlines are almost always struggling financially. Bankruptcies are common. Bailouts are routine. Profits are thin, inconsistent, and often disappear entirely during economic stress. Major carriers that seem invincible suddenly declare bankruptcy. Iconic airlines vanish or merge into competitors. Government rescue packages appear with predictable regularity during crises. This isn't because airlines are badly run, though management certainly matters. And it's not because people stopped flying. Air travel has grown consistently for decades, with temporary disruptions followed by recovery. It's because the airline industry is built on a financial structure that makes long-term profitability extremely difficult by design. The industry operates within constraints that guarantee instability. Once you understand how airlines actually operate beneath the surface, once you see the mechanics rather than the marketing, their constant financial trouble stops being a mystery and starts looking inevitable, almost predetermined. Airlines sell what appears to be a remarkably simple product: transportation from one place to another, point A to point B, a seat on a plane, movement through space. But behind that apparent simplicity lies one of the most capital-intensive, operationally complex, and financially precarious businesses in the modern economy. Planes are extraordinarily expensive assets. A single commercial aircraft can cost anywhere from tens of millions to hundreds of millions of dollars, depending on the model and configuration. A Boeing 737 might cost $100 million. A wide-body Airbus A350 or Boeing 787 can exceed $300 million. And airlines don't just need one or two planes. They need entire fleets, dozens of aircraft, hundreds for larger carriers. Each plane requires specialized crews, rigorous maintenance schedules, comprehensive insurance policies, fuel supply contracts, and strict regulatory compliance. The scale of capital required is staggering. And here's the critical detail most people never consider. Most airlines don't even own their planes outright. They lease them. That means they're locked into long-term payment obligations regardless of how full or empty those planes are, regardless of market conditions, regardless of demand fluctuations. If passenger demand drops suddenly, the costs don't disappear. The lease payments still come due. The maintenance still needs to happen. The crew still needs to be paid. This is the fundamental problem airlines face, the structural trap they operate within: extremely high fixed costs combined with highly variable revenue. A flight costs nearly the same amount to operate whether it's completely full or half empty. Fuel expenses remain roughly the same. Crew salaries don't change based on passenger count. Airport fees and landing charges are fixed. Maintenance schedules don't adjust based on load factors. Lease payments are constant. That means airlines live and die by seat occupancy, by load factors, by filling every possible seat on every flight. A few empty seats across thousands of flights can erase profits entirely. The margin between profitability and loss is razor thin. And because airlines compete aggressively on price, because they're forced to compete on price, they can't simply raise fares to compensate for empty seats. Air travel has become commoditized. Most passengers choose flights based primarily on price and schedule convenience, not brand loyalty or service quality. That forces airlines into constant price wars, relentlessly pushing margins thinner and thinner. Every carrier undercuts competitors to fill seats. Every sale and promotion erodes profitability. Every percentage point of lower pricing spreads across the entire fleet. This is why airlines obsess over load factors, implement dynamic pricing algorithms, and engage in overbooking strategies. They're not trying to be clever or extract maximum value from passengers. They're trying to survive in a system where even small inefficiencies, small miscalculations, can be financially fatal. Fuel adds another massive layer of instability and unpredictability to the entire operation. Fuel is one of the single largest operating costs for airlines, often representing 20 to 30% or more of total expenses. And its price fluctuates constantly, sometimes wildly, based on global oil markets, geopolitical events, currency movements, and supply disruptions. Airlines attempt to manage this risk through hedging strategies, purchasing fuel contracts in advance at locked-in prices. But hedging itself introduces financial risk and complexity. It's essentially making bets on future fuel prices. When fuel prices move in unexpected directions, when predictions prove wrong, hedging strategies can backfire spectacularly and amplify losses instead of reducing them. Airlines that hedged at the wrong time can end up paying far more than market rates, while competitors who didn't hedge benefit from lower prices. There's no perfect solution. Not hedging exposes airlines to price spikes. Hedging exposes them to contract losses. Either way, fuel volatility creates constant financial pressure. Labor represents another critical pressure point in the airline cost structure. Airlines require highly trained, highly skilled workers. Pilots with thousands of hours of experience. Aircraft engineers with specialized certifications. Flight attendants with safety training. Ground crews, maintenance teams, air traffic coordination. These are not easily replaceable workers. Training takes years. Certifications are rigorous. Experience matters enormously for safety and efficiency. And their unions are powerful, rightfully so given the critical nature of their work. Labor contracts lock airlines into wage structures, benefit packages, work rules, and employment guarantees that can't be adjusted quickly during downturns. When revenue collapses during recessions or crises, labor costs remain largely fixed. Airlines can't simply lay off pilots and rehire them later. The training pipeline doesn't work that way. Institutional knowledge matters. Safety depends on experience. This creates another structural rigidity that prevents airlines from adapting quickly to changing conditions. At the same time, airlines operate in one of the most heavily regulated industries in the entire world. Safety regulations are absolutely essential, obviously. No one wants to compromise aircraft safety. But compliance adds significant cost, complexity, and operational constraints. Planes must be maintained to exacting standards set by aviation authorities. Every component has a life cycle. Every system requires inspection. Every deviation demands documentation. Crews must be certified and recertified regularly. Routes must be approved by governments. Slots at airports must be secured, often through competitive processes. Airports themselves impose fees, taxes, and charges. Governments impose their own taxes on tickets, fuel, and operations. Environmental regulations add costs and restrictions. Security requirements demand infrastructure and staffing. Every layer, every regulation, every compliance requirement adds friction to profitability. The costs accumulate, compound, and compress margins further. And then there's competition, which operates differently in airlines than in many other industries. Unlike companies that can build durable competitive advantages through patents, proprietary technology, unique resources, or network effects, airlines rarely enjoy lasting structural moats. Routes can be copied by competitors. Aircraft can be leased by anyone with access to capital. Service quality is difficult to differentiate meaningfully in a price-driven market. Brand loyalty is weak compared to other industries. New carriers can enter markets during good economic times, flooding profitable routes with additional capacity and driving prices down through competition. When conditions worsen, weaker players collapse or consolidate. But the survivors inherit an industry that resets only temporarily before the cycle repeats. This boom and bust dynamic is built into the industry structure. It's not an anomaly. It's the baseline operating reality. Airlines also suffer from extreme demand sensitivity. Their revenue is deeply tied to broader economic conditions, consumer confidence, and external events largely beyond their control. Economic slowdowns reduce business travel and discretionary leisure spending. Pandemics ground entire fleets. Geopolitical conflicts close airspace and deter travel. Fuel price shocks hit simultaneously as supply shocks and cost increases. Even severe weather events can cascade into massive operational disruptions and revenue losses. When demand collapses, it can collapse almost overnight. But airlines can't pause operations without catastrophic losses. Planes still need to be stored properly, maintained continuously, and financed. Staff still need to be paid or compensated through layoffs. Contracts still bind. Fixed costs persist even when revenue vanishes. This is why airlines are consistently among the first industries to seek government bailouts during major crises. Their failure has systemic consequences beyond just the companies themselves. Air travel is critical infrastructure for modern economies. Connectivity matters for trade, business, tourism, and logistics. Governments understand this reality, which creates an implicit safety net beneath the industry. Ironically, that safety net encourages risk-taking and financial leverage. When companies know they're likely to be rescued during catastrophic failures, when bankruptcy doesn't mean liquidation but rather restructuring, they operate with thinner margins and higher leverage than they otherwise would. Airlines take on massive debt to expand fleets, open new routes, compete aggressively for market share, and invest in growth. They operate close to the edge financially, knowing that collapse doesn't always mean extinction. It often means reorganization. Bankruptcy, in the airline industry, is not necessarily the end. It's frequently a reset button, a financial do-over. Through bankruptcy protection, airlines can renegotiate labor contracts, restructure oppressive debt loads, reject unfavorable leases, and shed unprofitable obligations. Shareholders may get wiped out completely, but the airline itself often emerges leaner, with lower costs, and ready to compete again. This cycle has repeated itself across decades, across multiple carriers, across different economic eras. From the outside, from a casual observer's perspective, it looks like failure. From inside the system, from a strategic standpoint, it's a tool, a mechanism for resetting cost structures that couldn't be adjusted otherwise. This financial reality also explains why airlines focus so intensely, so aggressively, on ancillary fees and revenue streams beyond the base ticket price. Check baggage fees, seat selection charges, priority boarding premiums, change and cancellation fees, onboard food and beverage sales, Wi-Fi access, extra legroom seats, early boarding, lounge access. These are not merely add-ons or conveniences. They are essential profit centers, critical revenue streams. The base ticket price, the advertised fare, often barely covers direct operating costs. Real profit, actual margin, comes from charging passengers incrementally after the initial purchase decision. From monetizing every aspect of the travel experience, airlines have become experts at psychological pricing, presenting low base fares while extracting value through dozens of smaller charges that accumulate across millions of passengers. Frequent flyer programs play a similar, even more profitable role in airline economics. Loyalty points, airline miles, these are not just customer rewards or retention tools. They are financial instruments with real economic value. Airlines sell miles in bulk to banks and credit card companies, who then distribute them to cardholders as incentives. This generates enormous cash flow for airlines, often upfront, before passengers ever redeem those miles for flights. In many documented cases, the loyalty program itself is more profitable than the actual airline operations. The flights become marketing channels, distribution systems for financial partnerships with banks and credit card networks. At this point, airlines stop looking like pure transportation companies and start looking like complex financial machines, leveraging multiple revenue streams, built on thin operational margins and creative monetization strategies. If this structure sounds familiar, it should. Many modern industries operate exactly the same way. High fixed costs, aggressive competition, financial engineering, reliance on debt, and cyclical boom-bust patterns. Airlines just make the structure unusually visible because their product is so tangible, so visible, so easy to understand. You can see the planes. You experience the service. You notice the struggles. But the underlying dynamics, the structural forces, appear across industries. This is how modern capitalism operates at scale. This is why airlines can be everywhere, indispensable to modern life, moving hundreds of millions of people annually, and still constantly on the edge of financial failure. They are not broken businesses run by incompetent managers. They are businesses operating exactly as their financial structure, their competitive environment, and their cost dynamics allow. Understanding this fundamental reality changes how you see headlines about airline losses, government bailouts, and bankruptcy filings. It stops looking like mismanagement or bad luck. It starts looking like the natural, predictable outcome of an industry designed around leverage, volume, razor-thin margins, and systemic risk. If you want to understand how institutions really work, not just airlines, but banks, corporations, insurance companies, credit card networks, and governments, this channel exists to break those systems down piece by piece. to show you not what companies say they do, but what they actually do. Not the marketing story, but the structural reality. And if this kind of deep structural explanation is valuable to you, if you want to see past surfaces into systems, subscribing ensures you don't miss future breakdowns, the kind that don't show up in advertisements or press releases, but quietly explain how power and money actually move through the world.